If you're at least age 72, you probably know that you're in what's called the required minimum distribution territory. This is when you're required to take at least a minimum amount out of your tax-deferred retirement accounts and pay taxes on that amount. For people with especially large accounts, taking even the minimum can result in a much larger tax bill than they'd anticipated. Of course, if you need those funds to pay your monthly expenses, there's not much you can do except bite the bullet and pay the taxes owed. But if you don't need the money, the required minimum distributions are really nothing more than an added tax bill for you. This is where something called a qualified charitable distribution, or QCD, may be able to help. The only requirements here are that you don't need the IRA distribution to fund your living expenses, and you already plan on giving money to a qualified charity sometime during the tax year. So how does this strategy work? Well, it's really pretty simple. Once you're at least age 70 and a half, you decide how much money you want to give to your charity or multiple charities. You then instruct your IRA custodian to transfer that amount of money or some portion of it directly from the IRA to that charity, bypassing you in the process completely. By doing it this way, by giving the money directly to the charity from the IRA, that amount will not appear on your tax return as a taxable event to you. You can give as much money as you want, up to a combined $100,000 for the entire tax year, and that amount will count towards satisfying your required minimum distribution. The combined result is this: your charity gets the money you wanted them to have, and it counts towards your required minimum distribution for this year, and it's not part of your taxable income for the year. You might be asking, why is it better to do it this way through a QCD? What if you just took the RMD for yourself as normal and then just turned around and wrote a personal check to the charity? Logic would dictate that RMD would be taxable coming into you, but the money that you're sending to the charity would be potentially deductible going out. So the two of them would kind of cancel each other out, right? Well, logic and tax law rarely go together. What really happens is that when you take the RMD for yourself and add it to your tax return, as you would normally do, that income is counted above the line, meaning it adds to your adjusted gross income for that year. If you're able to itemize, and most people can't do that anymore, your charitable donation happens further down your tax return below the AGI line. When your adjusted gross income goes up, there's a good chance you'll increase the taxability of your Social Security. Or you can push long-term capital gains from the 0% bracket to the 15% bracket. A higher AGI can also mean an increase in your Medicare premiums as well as your Medicare surtax on capital gains. It may also phase out of some of your itemized deductions, among other things. So doing it in the non-QCD way creates a kind of ripple effect across your tax return, and not in a good way. By doing a qualified charitable distribution, your AGI does not go up, which means you stand a better chance of avoiding the issues I mentioned a moment ago. And here's a bonus. If you don't itemize and thus can't deduct your charitable contribution, by doing a QCD, you get what amounts to a de facto deduction. Here are a few rules to keep in mind when you're considering a qualified charitable distribution. The IRA owner must be at least age 70 and a half to do this. There's a $100,000 per year donation limit through a QCD per taxpayer. So a married couple can each do up to $100,000 if each distribution comes from his or her respective IRA. This works only for individual IRAs, not from any kind of employer-sponsored retirement plan like a 401k. One other thing to watch out for: the 1099 tax form that you receive from the IRA custodian will not list the QCD as a separate distribution. It's just part of the total distribution that was sent to you from your IRA. Since there's no code, your tax preparer won't know about it, and they'll just list it as part of your normal taxable distribution. So make sure to tell your tax preparer that you did the QCD. And one final thing here, which is a change from a few years back. If you've made any contributions to your IRA post age 70 and a half, which we can do now thanks to the Secure Act, those contributions have to come out first. They can't be turned around and used as a QCD. So the rules effectively require a LIFO treatment that ensures post-age 7 and a half contributions will first and foremost be used to reduce your ability to do future QCDs. But hey, that's just a minor detail. A QCD still can make sense for anyone who's charitably inclined and who doesn't need their required minimum distribution to fund their living expenses. If you are over 70 and a half and make charitable donations, you should be using qualified charitable distributions. If you want to know whether you may benefit from this QCD strategy, we do this kind of thing for our clients every single day at Lucia Capital Group. How can we help you the most? Just give us a call.